Hey there, welcome to the Growth Whisperers, where everything we talk about is building enduring great companies. And especially so this week. We always do, but now a little bit more so this week, where we're talking about part two of a two-part episode on building enduring great companies. I'll get it out. G'day, Kevin. I hope you're able to get some words out this morning.
I'll try. I'll do my best, Brad.
Good. How are you today, my friend?
I'm doing good. As always, looking forward to our episode. I mean, for the listeners and the viewers to know, like we really have a lot of fun preparing for these and kind of, smashing our brains together around different concepts. And, I'm usually quite pleased with what we come up with. And, and what's coming out of today and the previous episode is some stuff as we're working on some new creative work together, the output of a brainstorm, and one thing led to another thing, led to, for us, some really powerful thinking. And I'm really excited about sharing it. So yeah, I'm looking forward to the show today.
Awesome. So we're going to begin, as we always do, with word of the day. Word of the day. So we encourage people to start meetings with a word or phrase, just to kind of lighten things up, set the tone, get an understanding of where one is at. And for you, what might be your word of the day or phrase?
Yeah, my phrase of the day is my word, I'd say, is relationships, and just the value. And I am recently so insanely grateful for the relationships that I have. At the end of the day, you can have stuff, you can have money, you can have all kinds of things, but at the end of the day, the people that you get to spend time with are what really make it all worthwhile. And if I look back over the past week and think about relationships and spending some time with some good friends, some time with my son, some quality time with my daughter, and just the people that I'm surrounded by, and the quality of the relationships is the quality of my life, I guess, is the way I would sum it. So maybe the phrase is, my word became a phrase, Brad. The quality of your relationships is the quality of your life. And I have an abundance of amazing people that I'm fortunate enough to call friends, really, really good friends. And we're there for each other and taking care of each other. So yeah, that would be it. The quality of your relationships is the quality of your life.
Well, that's lovely. Mine, that is so lovely. It just warms the cockles of my heart. And mine
Here it comes.
So incredibly cold compared to that one. And it's one that you and I had spoken about recently, but it's really been playing on my mind. And that is that if it is not a law of nature, it's an opinion. If it's not a law of nature, it's an opinion. So many people have so many things that they sprout as being facts, but it's probably just an opinion. So gravity, for example, is probably a law of nature. It's very hard to say that's an opinion. Yet at the other end of the spectrum, there are some things that people say which are in actual fact really just their opinion, but they're making them sound like facts. So I heard that from a guy called Shane Parrish, who I kind of have listened to for a while and like the way that he thinks. It just really resonated with me. And so that's my phrase of the week.
I love that. So for the people that think the world is flat, they would say that they must be able to say it's not a law of nature, therefore it must be an opinion that the world is round and that the world could be flat. Like I'm kind of sure think it's a law of nature, isn't it, Brad? That the world is round?
I cannot believe that you raised that, because that there was a seed that I was thinking about in relation to today's topic, like in the previous days. And that is, if you go high enough above the earth, you can see the curvature of the earth. And it's the same.
Yes. If you get enough perspective, you can see the truth.
Yes.
Boom. But if you're right on the ground and you're too close to it, you can't see past the end of your own nose and you can't really get the perspective.
Yeah. Yeah. So, for flat earthers, they just don't look for the science. They look for things that validate their opinion.
Of course.
Okay. And that's not, necessarily it. So it's not a law of nature. It's an opinion. And some people's opinions are, quite accurate. Others are not so much. So,
So my phrase of the day: the quality of your life is the quality of your relationships is the quality of your life. Is that a law of nature or is that an opinion?
That's an opinion. It is.
Well, but if you look at it, you look in the animal kingdom, the relationships that you have with some of these pack animals is their strength and their ability to hunt and their ability to eat. Like, is that the quality of their life, the quality of their relationships? Because if you take a pack hunting animal, like wolves,
they rely on each other.
They do. The quality of their relationships probably is the quality or even the length of their life. I'm sure we could spin this any way you wanted, but I actually wonder if it's a law of nature or if it's an opinion. I mean, it is an opinion I have, but I wonder if it's a law of nature for a killer whale. I just saw, by the way, as I was sitting here today on the phone with a friend, and I was looking out, and I said, "There's a whale." They actually thought I called them a whale, which was a miscommunication on the phone, which is a whole other conversation. But I saw the whale out the window, and it was blowing. When the whales come up to the surface and they blow air out and make a thing that shoots up in the air. And I don't know why I'm talking about whales. What was it got me there? I was
law of nature
and whales. So killer whales are also pack animals that hunt together and rely on each other. So is the quality of their relationships. So anyway, we don't need to go down that road. That's not what the show is about. But I wonder if that could be considered a law of nature.
Yeah.
And I know
it's an interesting thing. It's an interesting concept to sit with.
If I couldn't convince you, I could go find some flat earthers and figure out how they make their arguments for things that may not be, and then I could probably find a way to convince them. Well, we don't need to go there.
We do not. So this is part 2 of 2. This is the second episode. There is a first episode. If you're listening to this episode, I'd probably recommend that you listen to the first episode before the second episode may make a bit more sense today.
Correct. So today in part 2, we're going back to the same question. Are you planning to sell, or are you planning to keep your business? Or are you in this painful place called the mediocre middle, which we talked about a lot in the previous show? And really what we were talking about in that previous show, a real quick summary for you, is that, the no plan is great for vacation sometimes, not always, or Sunday afternoons. But it doesn't really work for business. And, the avoidance of plan or freedom from plans doesn't give you freedom. It actually gives you more pain. And, having a strategic plan and having a shareholder plan for what you're going to do with this business for the long term, which in many ways would influence part of your strategic plan. And then really, how do you know you're in that mediocre middle? And the root of it is you tolerate a lot of stuff. You might not even think about it. You may not be even thinking about the difference between, if I was to build this business for 30 years or flip it in 3. But no matter what, the business is probably draining you in a bunch of ways. And that would be a root symptom. And, the phrase that we kind of talked about is that, are you having to endure your business, or is your business giving you endurance? And as sort of a distinction, that's what we talked about in this last show. So today in our show, we're going to talk, well, how do you get past that? If you happen to be in that mediocre middle, how do you either get to the point where we would, ideally recommend you try to get to? It's the ideal place to be, is building it to keep it for a long term. If you've built an amazing asset that produces value and purpose and cash, why would you get rid of it? Although if you choose to exit in the short term, that's another choice, and you could make that too. So we're going to get more into some of the how-to around it. Anything you'd add to that there, Brad?
Yeah, I just want to reinforce the concept from last week very quickly, and that is, if you own a business, you are either building it to sell it, you are building it to keep it, or let me reinforce that. You have a plan to sell it, you have a plan to keep it, or the third point is you are stuck in the mediocre middle. And so many people are stuck in the mediocre middle. Last week we spoke about the what, and this week it's really about how. How do you understand and how do you, what do you do about that? So yeah, let's jump into it. So like we spoke about not a few moments ago, if the higher that you go up, the greater perspective you get, you can begin to see further, and eventually you can see that the earth is curved. So it's about the time horizons. If all of the thinking that you're doing is on a really short-term basis, like, you know, at this point in the year, kind of middle of the year, I just want to get through till, you know, the end of 2021. That's all I want to do. That's all I'm focused on. If you've got that short-term horizon, you're kind of at 1,000 or 2,000 feet. You can't see that far and you can't think that far. But if you go up higher, higher, higher again, you can see a lot further away. And you can think beyond the next year, beyond the next quarter, beyond the next year, beyond the next few years, and you can begin to get different perspectives. And going back to what you said, are you enduring your business? Or are you building endurance into your business or something like that? That's really what we're saying, is that if you have to work with your business, like we said in the last episode, for 20 years, if you are wedded to that business for 20 years, wouldn't you build the business that you really want to?
Exactly. And so to help us today, the starting point is to really look at this, look at your business through time horizons, or as Brad talked about, you know, almost zooming out to see it in perspective. And really there's two different tracks you can look at it. If you want to look at it from an economic point of view, looking at your business through the next market cycle. So right now, for example, in many economies in the world, we're at a high point in an economic cycle, massive, you know, growth. Like in Canada, things are incredible for most businesses. You know, we call the economy is very frothy. There's just it's just booming, all-time highs and lots of things. Lots of our clients like record profits. It's incredible considering we're coming out of a pandemic. And so, you know, when the cycles, after a period of boom, there is a softening at some point, and then there will be another boom and then a softening. So if we're at a peak or approaching a peak, you never know, it would be looking through the next trough to the next peak and really thinking about that. And generally, that's at least a decade into the future, but really thinking about, okay, what do we have to do through the trough to then better capitalize on the next peak? The second that some family businesses kind of might look at, they might look at that way, or another way is looking at the next generation of leadership, and whether it's family or not family business, but basically the time frame at which the CEO and executive team are completely replaced, i.e. 100% or 80% of them are replaced. So we're working with a company actually in Canada. It's been around more than 100 years, and we're working on helping them with succession for a CEO and I think four or five of the key leaders in the end. I think it's 4. And so we're going to work with them on assessing internal candidates and helping them to make the right choices with some tools that we have to help them do that. But this is a 3 to 5 year project to get that right. But they're starting now because they're, and for a while they've been thinking about when they have this next executive team. So whether it's next market cycle or next CEO and executive team taking it through the next growth curve, really zooming out to think about that and getting well beyond the daily tactical or even more typically what we call strategic decisions.
Yeah. So if you zoomed out a little bit more, you could imagine something that looks a bit like a sine wave. I don't know if you know what a sine wave is, but if you could imagine something that goes up and then it hits a peak and then it goes down and then it hits a trough and then it goes up again. So it's going up and down, a bit like a continual roller coaster. So in a conceptual model, that's kind of what the economy does. It goes up and then it goes down, or maybe that's what the industry does. Now,
except for it's on a bit of a tilt, because
that's right.
it goes to a new high generally, and then the low is a lower low and the high is a higher high. So it's on a bit of an angle. It's in many ways, it's kind of like a heart rate, heart rate when you're in the hospital, which, I recently found out about, and you can see your heart, your heart, they're checking your heartbeats or whatever going up and down. And except for they just put that on a slant as it grows. Yes.
Yeah, that's right. So if you think back to, I don't know, 2006, 2007, things were pretty hot. Then you go back to about 2009 or 10, where the GFC, things were pretty not. And then what's happened since then is things have become hotter again. And eventually that will turn and things will go down. So we can't be very specific about the time horizon, but it's not quarterly, right? And it's probably not yearly. You're zooming out further than that to think about the multi-decade ups and downs at the beginning, and then kind of asking, well, where are we at? And you mentioned at the moment where, things are hot, we're kind of on the up, if not the top. And then where's our industry relative to that?
I got it, Brad. It's like, it's basically, and we need a name for it, because we have the name, because there's tactical, which is like a year or so. Mm-hmm. There's strategic, which is generally 3 to 5 years for most companies. And then there's almost cyclical or something else like that. Cyclical would be different, where you're looking in that 10 to 15 year time horizon. And then Collins has the BHAG. Yeah. And that's like, closer for most companies. He says 10 to 30 years, but it's generally, that's a 20, 30 year time horizon for a lot of the companies we work with. So it's this, it's almost, tactical, strategic, and then a cyclical point of view. And there's a better name for it.
I think that's not bad. That's
not bad.
Yeah, like that's a good start, and maybe we'll keep that. But the point is, so many people are caught up in the moment right now. It's hot, and people are guided by often emotions or sentiment. And if you can zoom out far enough, you can say to yourself, well, you know what, we're almost at the top. That means at some point things will begin to go down. And when things begin to go down in the economy or the industry, or, our client's industry, or whatever it is, when things begin to go down, we will need to take a different set of actions, and we need to be prepared for those actions. And that's the reason that we're saying this, talking about cyclical, is endurance, because the only way that you can endure is if you can endure these cycles. If you could build a fantastic company on the way up, but when things come down, if you're saddled with too much debt and you can't service that debt given the new operating environment, you're not going to endure.
No, because you're dealing with different forces. And as you were talking, I looked up cyclical, and I found another reason was seasonal, right? You go through a season of growth, right? And a season of kind of plateau and a season of decline. Seasonal is another word. We'll get that word later. But you just need to be able to handle the different environments, even with it. And this is it. Your strategy is excellent, but then it's almost on a different axis where you're looking at the different environments and what can you do to, because right now in the economy, there's a lot of people, my gosh, in Canada, we haven't really had a notable slowdown close to 20 years. We had a little blip in 07, 08, but Canada didn't get affected that much. So for a lot of people, if you've been in business for 19 years, it's like, like people think the world's flat. You think the world is growth.
Yeah.
Like you don't know, you actually haven't experienced any different. Yeah. But what we're talking about is knowing that things are cyclical and that you need to see to the other side of the next cycle. That's it. So if it's been almost pure growth for 20 years, close, knowing that it's going to do this, and then it'll, it's going to dip, and then it'll go back up again. For those who can't see my hand moving on the screen. So it's being aware of it and planning for it, and then looking at your business through its ability to endure that and come out stronger versus blind positivity.
There's a famous investor by the name of Bill Ackerman, and I heard Bill speaking maybe 2 weeks ago, maybe 3, and he said, he was talking about inflation. So the hot thing at the moment is inflation. People are talking about, lumber's up 100%, steel's up this much, so forth. And that's the other thing that we're seeing is a shortage of workers, certainly where I am and in other areas as well.
Here as well. Yeah.
And so when there's a shortage of workers, often that drives wages up. And the thing that Bill said when they said, is this transitional or is it permanent? And what that means is this just for the pandemic? And like it's all the stimulus money that's making this problem. Yeah. And he said, here's the thing. It's very hard to take away a pay rise.
Yes.
Okay? And so that's where the inflation on the labor market comes from. And if you say we're going to pay more so that we can get enough workers, like where is the point where you go, okay, now we're going to come back to where we were? Like no one does it. Almost
with wages, it's very hard for it to go back down. Commodity prices can go up and down.
Yeah.
And we're having this discussion with a lot of companies right now, Brad,
yeah.
because getting workers, and for example, in some countries like Canada and US, immigration is required for a bunch of the labor pool, like required.
Yeah, me too. Over here too.
But with COVID and a lot of the immigration halted, then there's less labor pool coming in. And so absolutely. And the conversations we're having in companies is that as wages are getting more expensive, as you pay market wage, the current market wage for new people, well, sooner or later you need to equalize it for existing people as well. Yes. So it's not just one person getting paid a higher amount. Over time, everyone at that level probably will have to, and the whole thing moves up a notch, which drives the cost base of every company up. Yes. Which then prices have to go up to support that cost base. And so in the end, the real money going to those employees actually isn't that much different, because they get an increased pay, but then inflation goes up. So then it almost takes them back to where they were, and the whole system just moved up a notch, which is inflation.
Except when you're zoomed out and looking at this roller coaster, this cyclical, this sine wave,
yep.
And whatever, be the economy or your industry or your client's industry, and demand decreases for your product, and you've got these established higher wages, what are you going to do about it? This is about building an enduring great business. How are you going to deal with that? You may have no choice but to put those wages up. But if you're thinking about the fact that will eventually go down and you'll have these new higher costs, that is how you endure.
Right. Yes, and exactly. And again, it's zooming out to see what's really going on, which takes time.
Yeah.
And you need to, and there's a lot of variables to understand this. So if you go back and look at this, really, it's about zooming out and looking beyond, beyond to the next cycle, which would be that cyclical thinking, not just strategic, or that next generation of leadership, but it's a longer term standing farther into the future and thinking about all the things we're doing today and how it's going to impact us 10 years down the road. And so you need a certain right group of people looking at this, and you need the right questions or the right conversations to do it. And most people, as we talked about in the last show, are so caught up in shorter term thinking, which is excellent for running the business, right? You need to, when you're tactical and execution, you got to be thinking shorter term, but someone ideally is thinking about the strategic time frame, 3 to 5 years, and the cyclical time frame of probably 10 to 15 years.
So I've got 2 questions for you, Kevin. Question number 1, when will be the top of the market? And question number 2, when will it go down?
Absolutely. What I can tell you is that the day that we hit the peak, I'll probably be able to tell you the week after. So whenever it happens, soon thereafter, we'll probably know. and how much it goes down and everything else, I will absolutely be able to tell you in hindsight, because we have no freaking idea. No, and I can remember one time I was sitting in the Middle East, and we had brought in these economists to help us get a sense of what was going to happen with currencies. And they sat there with their best abilities and their most confident opinions to predict currencies and where they were going to go. And as someone said at the end of the meeting, and respectfully, these were very well educated, they were doing their best. They said, and if economists could accurately predict any of that, they would be the richest men and women in the world. And they're not, because it's impossible to call.
Wait for it. Are you ready?
I'm here it comes. Yep.
We can't predict the top, and we can't predict when it will go down, but it's a law of nature that it will go down.
It will.
It's a law of nature. This is
back to a law of nature. Beautiful, Brad, but it's true.
It is.
We know that it will go down. No idea what happens or why. And you can trace back some of it, but it will go down. And then it will generally go back up again. That is what it's done for how many years?
Yeah.
And that's why even when we get to some of the things that you need to do, that's why this thing called a balance sheet is really important. Because your balance sheet needs to work when it goes up, and knowing that it goes down, your balance sheet, needs to be able to endure that. And just like your boat needs to be able to endure big storms if you're in the ocean.
And if you're in the mediocre middle, right, you're not planning to sell and you're not planning to keep. If you're in the mediocre middle, you're not conscious of the fact that it will go down, and you're not preparing for that.
Quite likely. And some people in the mediocre middle are really conservative, and they might have, a whole bunch of cash in the bank or not have a lot of, who knows? Mm-hmm. But the point of it is it's being conscious of that fact that it will go up and down. And what are you doing to thrive during that? Not hold on by the end of your fingernails. So time horizons is the piece that we're talking about. And really what we want to share with people today is that, if you know that the cycle is going to change from your current cycle. So if you're in a boom cycle like we are in Canada and Australia and the US and other countries, because we know it's going to go down. We know that. And as Brad has identified, we don't know when, but we know it's going to go down. That is a law of nature, and so far a law of economics, or a principle of economics. What if, knowing that the economy will go down and it will, it'll hurt some, what is the one thing in your business you should be tweaking now or bulletproofing, or to future-proof your business for this next economic slip? And whether it's 2 months or 24 months or 42 years, I don't know. I have no idea. Generally, based on history, it won't be 42 years. But what is the thing that you need to do? So just take a second right now and think about it. Knowing the economy will slow down some amount at some point in the nearer future, what's the thing you need to do to better position yourself to do very well when it slows down?
So here's an example. There's a guy called Jack Stack, wrote a book called The Great Game of Business, was famous for buying a company called SRG Holdings, I think, from International Harvester. SRC, thank you.
Yes.
SRC Holdings from International Harvester, I think it was. And because the company was basically losing money and was going to go out of business, turned it around. Yep. And subsequently, I think he built 60 companies greater than $50 million. Like, he's no slouch in this area. In any case, so Jack takes this view, the enduring great long-term view. And what Jack and his team do is they say, on the up, we're accumulating cash so that on the down, we can buy assets. And I remember when I met Jack in the US, and he told us the story, and I don't think it's out of school, I can say it. He said it was something like they were buying land at $2,000 a square foot when in the upswing, it was like $15,000 a square foot or something like that. I've
heard them tell that story, but basically they were picking it up for next door to free.
Yeah.
During the downtimes when there's distressed assets on the market.
Yes. Yeah. So if there is a downturn coming at some point, do you have the balance sheet to be able to weather the storm, and then be able to pick up distressed assets that will make a meaningful difference on the next upturn? Because there will, just like it's going to go down, it's going to go up.
Yeah, and it always does. And you know that when it goes down, there's a lot of people that get hurt in that process. And because, they don't have the cash to finish the process. So a lot of, real estate and things like that kind of get hurt in that process with a delay. Interesting that when companies start to grow, it's not as widely known, but more of a fact is that when the economy starts to grow again, more companies go bankrupt, because on the way down, people's cash flow improves for a period of time because they're carrying less inventory and they're catching, all those receivables are coming in, and the previous month's sales have been higher than the current month's sales. So generally, if they do it right, most companies can do okay in an initial downturn. Now, after a long time, it hurts. But when it cranks back up again, people are getting cash crunches, because if it picks up too fast, they can't cash flow the growth, which is a whole other piece that Jack talks about a lot as well. So basically, you got to be prepared to win no matter what cycle you're in, and looking at the next cycle is an incredible way to endure, and it's a great way to pressure test your company. Yes, it might be working great today, but is it going to work great when the economy is slipping and going down, right? When there's a contraction. So what we want to do is we want to kind of take a look and give you a sense of thinking where when things go down, whether it's the economy overall, it could be something in your industry, because, there's the macro economy, and then there's industries within economy, like oil and gas right now has been for a while a little slower, even though, the general economy as a macro has been doing quite well. So we've got nine different principles we've shared in previous podcasts that we talk about building an enduring great company. And I think we're going to take a look at some of those. Hey, Brad, is that the plan?
Yeah, that's right. So based on where your industry is at, based on where the economy is at, based on where your customers' industry is at, that's the kind of framing that we're beginning with. And then we're saying, think about these 9 principles to build an enduring great business, and then ask yourself, so where is that, and do I need to do any work around that? So the first one, of course, is strong culture and behaviors. That's the first principle. And so where you are at in terms of this cyclical movement at 100,000 feet that we've discussed, do you have a strong culture and behaviors that can withstand the way up or the way down or whatever is coming?
Yes. So if the economy or your industry continues to boom for another 5 years, are your culture and behaviors strong enough to hold it together and sustain that growth? Or if there's a decline, are your culture and behaviors strong enough to face a reversal in the economy and where things are going the other direction? And that's the question. And what might you need to dial in either scenario around your culture and your behaviors?
Yeah. And so importantly, before we move on to number 2, we spoke about the example of Jack Stack buying land cheap, but that was shoring up their balance sheet, or that was utilizing the balance sheet the best way. These are all of the 9 things that you've got to consider. Moving on to number 2, a long-term vision. So when things are going south, when your revenues are perhaps dropping, declining, or staying stagnant, or not growing at the rate they used to, do you have a compelling long-term vision that's going to ensure that people stick around and know what they're working on?
Yeah, and it gives people that North Star, or that Southern Cross, to be able to focus on and to stay thinking about as they go through it, because they know there's something great on the other side. They're just going through a transitional phase. But is that vision compelling enough for what you want to do? By the way, and we're talking in context if you want to endure and keep this business for the long time. But heck, even if there's a downturn and you're planning to sell, you might have to hold on to the business a bit longer. And having that same type of vision for people to focus on is critical. And a lot of times you find with companies, they have a vision, but it gets lost. It's not front and center like a big magnet pulling it forward. So that's the second one, long-term vision. Will it do well if you continue to boom for the next 3 to 5 years? Or will it do well if we go into a stage of decline, whether it's in your industry or the economy overall? The third, and again, this is a great one to pressure test both sides of the coin, continued growth or slowdown. And is, a strategy that gives you a sustained competitive advantage. If we continue to boom for 3 or 4 or 5 years, will your competitive advantage still be strong? Does it still give you a notable advantage? And a competitive advantage means you have a better ability than average to secure the work you want or sales that you want at the margins that you want, and don't have to give up margin to get business. So ideally, your gross margin is stable, and if not growing. And the same thing, if there's a decline, does that advantage actually work in a decline? Maybe your competitive advantage is it only works in a boom time. Maybe that doesn't work if the market goes the other way. Go ahead.
And I had that exact same situation with one of the clients that I work with, and it was an amazing advantage on the way up and at the top, and even a little bit as we started to decline. But in their industry, we've just had 4 or 5 years at the bottom, just bouncing along the bottom, and people in the industry would say, this is the worst we've seen in our whole life. Like, even the old timers say it's never been this bad. And it was like that for 4 or 5 years, and it didn't work. And so we just had to, because the competitive advantage wasn't strong enough to sustain through those down times, and we couldn't evolve it during the down times, all we could do was keep cutting to try to keep the business going. We did successfully. And now, of course, it's on the way up and it's going gangbusters. But the strategy that delivers a sustained competitive advantage should be able to endure through up and down of the cycle.
Yep, absolutely. Absolutely. And it was interesting. There's a client that I was thinking of as you're saying that Brad, and I'll save that one for the next. I'll save that one for the next one. So that's a competitive advantage. It's absolutely critical that it works, or maybe you have an alternate version of it if the market shifts to the other direction. And the whole idea of this is zooming out and thinking of the long term and not keeping your rose-colored glasses on all of the time. Can we actually flip to a different strategy or tweak our strategy to be relevant in a different market? Governance, you've got governance and the way that you run your business, and governance so that things run properly, and whether it's how decisions are made or authority is done. And the question is your governance working if the economy continues to boom? And, as I said, or if we slip into another market cycle, is your governance, does it have the speed? Does it have the safeguards? Does it have the risk management in it to help handle a different type of environment? Again, most companies in the last 20 years have been in North American market, have seen a fairly stable growth and not had to think about a down market. So is your what might need to change around your governance to be able to weather that storm?
Yeah. And so that's relative to the size of your company. If you've got a $5 or a $10 million company, governance is not something that needs to be completely ignored, as opposed to, say, a $250 million company where it may become more important, but it's still a consideration. If you would like to endure for the long term, governance has to be a part of what you do. I have a team that I work with, not that large a business, kind of $10 or $15 million, and they get one of the big 4 accounting firms to audit their numbers every single year. Now, that's because they're planning to keep, not because they're planning to sell. Because you might say, oh, they're doing that so they've got strong long-term books so that they can. No. They're doing that because they're planning to keep. Am I recommending that you do that? Not necessarily, but that governance element is what works for them.
It is. And on our larger clients, many of them have audits, not because the bank requires it, because they just want to make sure everything is being done right, because the shareholders are farther from the decision-making and the cash. And it's just a way to make sure the systems are tight and there's not any one weak systems, but also opportunities for cash to go walking out the door. It's also interesting, some larger clients, one we work with, it's about 100 million a year in revenue, but there's multiple partners. So when you have multiple partners, you often need to have defined ways that decisions are made and agreements. When times are good, unless you've got some greed, between the partners or personal conflict, people are generally good. When things get a little bit tight and there's things like cash calls and things like that, partnerships can get strained. So it's like, put the governance in the good times. Don't wait till the bad times to try and sort that stuff out. So the next one is execution systems to make sure the most important things or priorities are identified and completed. So, if your execution systems are tight, they're tight. Execution systems can pivot pretty well in good times or bad, but it's just to make sure you have tight systems. And most importantly that we find is that every quarter you zoom out and make sure the blinders aren't on, and you just don't execute the annual plan because you said you were at the beginning of the year. Sometimes you have to take, notable turns midstream. One of our clients that almost doubled their revenue and more than doubled their EBITDA in the last year through the pandemic, which is incredible. And it's an amazing company, but it's incredible. But we were looking at every quarter like a year. Like we took our execution system in an incredible boom. And every quarter looked at everything clean slate, like an annual planning session, just to make sure. And now that some things are changing for them in the economy, and it might decline, we're going to do the same thing again, just tweaking the execution system because of the different cycle.
The state that I live in, Western Australia, we have 10% of the Australian population, yet we contribute 30% GDP. Okay. And so
really,
and we're 1/3 of the geographic country landmass. Okay. So, our state economy is an extreme boom bust. We're either in an extreme boom where it's a struggle to find people, or we're in an extreme bust. And because it's mining based, it's ultimately
sounds like our province, which used to be primarily resource.
Yes,
it's changed in the last 20 years, but it used to be primarily resource based, and it was like that.
Yeah,
too.
We'd like to get some tips from you on how to move away from that. But we're like the Silicon Valley of mining and resources here.
Yes.
Okay, so it's extreme. And what we've learned is that you can many companies lose money on the way up, and they lose money on the way down. Okay. So poor execution can occur on the way up because it's a desperate scramble. And these execution systems get dropped or lost because we're so busy trying to execute the big projects that we're getting, or the big things that we're doing, and chasing all of that growth. So that's specifically not working capital requirements. That's not growth sucks catch. That's just bad execution on the way up and bad execution on the way down, because everyone's busy. So
and sometimes they're executing thinking that it'll get cleaned up as they go forward. They're kind of pushing the problems ahead.
Yeah. And at the moment, I'm dealing a lot with those kind of problems. So knowing that you need to have the execution systems and the priorities identified on the way up and on the way down, and it may be different. So let's move on to number 5. You've got to ensure that you've got the data to make the right decisions. If you want to build an enduring great company, people who are managers, their job is to make decisions, not to collect data like, people who are going out to collect leaves in the forest. Their job is to receive the data that is provided to them and to make decisions. So where are we at in the cycle that we're talking about here, on the ups or the downs? Where is your industry at?
Right.
And what's the data that everyone needs to make at this point in time?
And generally, a lot of times what happens for companies is when in a boom time is that they're focused on revenue, and they often neglect cost because there's so much revenue and growth happening. And the companies that we work with that have been through a few cycles, they're a little wiser for it, or sometimes just in the culture, but they tend to pay a lot more attention to costs. They watch the costs of the growth, and they don't assume that the growth will cover the costs in time. So it'll be like watching overheads always, and watching the SG&A expenses, or the specific SG&A overheads, another term for overhead, but looking at the operational costs of the administrative costs and keeping a handle on them. Of course, your company needs another person or two in the accounting team. But if you do mathematically, is it warranted based on your industry? If accounting should be 0.9% of revenue and you're running at 1.2, you may have another issue. So it's, cost discipline and data to help you know. And again, so different, you might be looking for different data in a down market than an up market, cost being an example. Principle 7, consistent profit generation and growth. So the whole idea is that the most enduring great companies consistently generate great profit, and they keep tension around it. Now, it's not that they're afraid to reinvest. They do reinvest, but they have a discipline around creating profitability. They have a skill around creating profitability. And one of the big ones is that they truly review, whether it's weekly. Jack at SRC in his book, Great Game of Business, would have you be doing it weekly. But for a lot of companies, they would at minimum do it monthly, but a full P&L review of every line item and making a handful of decisions to improve profitability and the performance of the company based on the numbers of the month. And again, ideally, it's done weekly through KPIs and other things, or in SRC, even through the financial statements. But real discipline around profit, easy to get loose around it in good times, like I talked about with the expense example. But even more discipline required to succeed with that in challenging times.
And then next, of course, balance sheet to endure the biggest storms. The biggest storm cyclically is what goes up must come down. It's a law of nature, if you will. And so knowing that these challenges are coming, knowing the stuff that we spoke about before, about if your wages are going up, okay, your revenue or the amount of demand that you've got may reduce over time. How are you going to withstand that storm that will eventually come so that you can endure?
Yeah. And in boom times, sometimes we can get in shorter term thinking, we can get seduced into thinking that things will continue as they are. And again, zooming out, what's the war chest? How do we set ourselves up to not only handle the storm, but to be able to capitalize on it? Because the storms shake a lot of things loose. A lot of trees will fall over in the forests. A lot of opportunities open up. And if you're there with a strong balance sheet, or ideally a stack of cash, a big mountain of cash, you can make some of your best moves ever. And finally, principle 9, a people magnet machine to attract and develop future leaders. And people make the difference. And it's the last one on our list, could be the first, you could argue, but it's critical, is that, in the booming times, are you attracting and building the right people on your team? And then are you setting yourself up for the down times? So even it's as simple sometimes as having a flexible workforce or outsourcing some parts of your business, so that if you do have to scale back, you don't have to lay people off. You just use less of an outsourced service provider. Or, one of our clients is in the business of providing short-term employees to the medical industry and IT. And when things slow down, they just use less of that service provider. And again, they're not, having to change the core team. There's many, many things around that people magnet machine, but it's really, what are you doing? So for example, right now in a booming economy, lots of companies are doubling down on recruitment, because it's harder to get people, right? And you can either pay a lot more or invest more in recruiting, for example. We talked about that a little bit earlier. So what would you add to the people magnet machine there, Brad?
Probably two things. First of all, your employee promise or your employee value proposition, and then the virtual bench. So first of all, the employee promise. So no matter where we are in the cycle, at the bottom, at the top, in the middle, how are you building your employee promise, your employee value proposition, so that the top the A players in your industry are going to want to come to work with you? That's the people magnet machine. And then secondly, how how are you going to identify, if you're, let's say we're at the top of the cycle, how are you going to identify who are the A players that are going to be out of work in 2 years, or their company is going to go under?
So, because if you're thinking to the next cycle,
you're
going to know that some companies are going to take a dip.
Yep.
And if you're strong and focused and run your business well, some of that amazing talent might lose faith in the companies that they're in, and you might have an opportunity for yourself there.
Yeah. Yeah. So again, when you zoom right out and you can think cyclical, who are the top 10% of the people in the whole industry? Do you know who they are? And are you tracking what's happening to their companies so that you can strategically target them to try to poach them from those competition?
Exactly. So that's the whole thinking of what do you need to do to look beyond the next market cycle in all these different aspects of your business. As we went through those, some things would have popped into your mind, some different things that you might be able to do to set your business up, not only for that dip, if you're in a boom, but then the next boom to be notably stronger and being ready for the next dip, and then the next boom, and the next dip, and being able to thrive no matter what happens. So, a quick kind of summary of the show. Again, this is part 2 of, are you planning to sell, or you're planning to keep your business, or are you stuck in a mediocre middle? In the mediocre middle, you're a passenger on this journey, and we do not want to be. We want to be in a driver's seat. We want to drive towards selling, or drive towards keeping this thing for 10, 20, 30, 40, 50 years. And, we talked about, in particular, looking at time horizons. And if you're going to be in this building an enduring company, you need to go from, there's the tactical, a year or so, strategic 3 to 5 years. And then there's cyclical, like 10 to 15 years that most cycles are. And then there's that vision, which is, 25, 30 years down the road. But sometimes you got to be thinking about cyclical in a bunch of your decisions to make sure you're set up to thrive no matter what happens. And really encourage you to pick the thing you need to do in more of a shorter version of what we're thinking, if the market were to change. And in a longer version, what do you need to do to ride that next wave or capitalize on the next boom? Anything else you'd add on there, Brad?
No, I think that's a good cover. Really, what we're saying is, if you want to build an enduring great business, you're either planning to sell or you're planning to keep. If you aren't doing one of those two, then the third point is that you're stuck in the mediocre middle. If that's the case and you want to understand how to move forward, you need to zoom right out, think about the whole economy or the industry in a cyclical manner, and then begin to plot yourself where you are against these 9 principles of building an enduring great company.
Yeah, awesome. So, hey, thanks for listening. This has been the Growth Whisperers podcast with Brad Giles and Kevin Lawrence. For Brad, you can go to evolutionpartners.com.au, or for Kevin, lawrenceandco.com, or you can go to YouTube and just search for the Growth Whisperers. Hope you have a great week.